For more here, let's bring in Dan Pickering. He's CIO of Pickering Energy Partners. And Dan, the best of times, the worst of times for the energy space. What's your broad read on things?
Kelly, my broad read is that $70 oil is not a bad number for the sector, but it's disappointing compared to where we've been. OPEC just had a big meeting. They said they'd extend their cuts to 2024. Saudi said they'd take 1 million barrels a day out of the market and do whatever's necessary to, quote unquote, protect price. And yet price is flat. So kind of a nothing burger coming out of the OPEC meeting. And so, the market's frustrated that we haven't seen more strength. It's coming. It's just a wait and see game that we're going to have to see inventories draw as we go into the back part of the year. If they don't, there's something wrong with demand, and $70 will be the number that we have. I think oil's going higher, though.
Yeah, I mean, it's peculiar because the chorus of people saying the economy is going to be fine, there's no recession, there's not even inflation, like everything is Goldilocks, and yet crude is acting so bearishly. So Goldman's thesis, it sounds like yours, maybe the entire energy markets, is that this is simply supply liquidation, and we've seen some evidence of that. Is that basically then the first half story, just way more supply in the market than expected, as opposed to demand weakness?
I think that's right. The fear of demand going forward is the overhang on the market. Plus, you have Russia that's continuing to produce well above their stated quotas. So you've been anticipating this tightening market. The market's not willing to anticipate anymore. It just has to see it. That's why we talked about this show me attitude. Show me that the market's actually physically tightening, and I think oil goes higher. China's numbers, China's 1 million barrels a day of incremental demand in the back part of the year, probably 2 million barrels a day overall of demand growth this year, 1.5 million or so of supply growth. So we've got a market that should tighten until it does. Traders are basically saying, prove it to me.
I got one more, if you'll indulge me, Dan, before I get to your stock picks. What's going on in the Permian? Is there a sense that volumes there have peaked?
I think that we've drilled our best inventory in the Permian. The fear is that the inventory of incremental locations to drill is starting to dwindle, and therefore production growth is going to be tougher. You couple that with the commitment of the upstream companies to return cash to shareholders, they're simply spending less money there. And so there's a view, and I think it's generally correct, there's a view that the U.S. It has sort of seen its best days of supply. We're at about 12.4 million barrels a day. 13 was the peak. I think it will take much higher prices to get us beyond that prior peak in production. So the Permian's still a great place to be. It's just slower because we're spending less money out there.
And two of your favorite names are Permian, Diamondback and PR. You also like ConocoPhillips, think Diamond Offshore. So just kind of quickly, why do these names you think jump out in an environment like this?
You bet. So in a world where oil probably does go higher, you want leverage to that. That's point one. Point two, these specific upstream producers, they do have good inventory. They're potentially takeout candidates. In the meantime, they're returning cash to shareholders with Diamondback. They're growing nicely if you're Permian Resources. So I like those two. Conoco, just a good, solid company with very low break even, so profitable at even lower prices. And then offshore is where activity is improving, and if you're drilling out there, you're paying more, so I want to own those rigs.
Yeah, all the more sort of focus on quality in this kind of environment. Dan, we'll leave it there. Thanks. By the way, I loved the podcast with Palantir the other day.
Thank you, Kelly.